Welcome to our video. Stop losing thousands, the 2026 IRS mileage rule explained. We will provide a CPA's guide to tracking business miles, bulletproofing your tax return, and keeping more money in your pocket. This is important because driving your car is one of your biggest potential tax deductions, but only if you can prove it to the IRS. Many people leave thousands of dollars on the table by not keeping a proper mileage log. The 2026 IRS standard mileage rate is 72.5 cents per mile. If you drive 10,000 business miles, that's a $7,250 tax deduction. That is real money staying in your pocket. There are two ways to deduct vehicle expenses: the actual expense method, which requires more documentation for a potentially larger deduction, or the standard mileage rate, which is simpler but still requires a proper mileage log. To use the standard rate, the IRS has a contemporaneous rule. This means you must record trips at or near the time they happen. You cannot reverse engineer your calendar at year-end. A mileage log must include 4 pillars: date, destination, business purpose, and miles driven. You must also record your vehicle's starting and ending odometer readings for the calendar year. You can use a paper log, where you write down the 4 required items every time you park. It works, but the likelihood of forgetting to log is high. The smarter choice is to use a mileage app like MileIQ, Driver's Note, or QuickBooks Self-Employed. These apps use GPS to track drives automatically and allow you to export a formatted spreadsheet for tax time. Be aware of the commute trap. Daily commuting from home to your primary office is not deductible. However, trips like going from your office to a client site are considered business mileage and are deductible. At the 72.5 cents per mile standard rate, driving 10,000 business miles can lead to a $7,250 deduction. Driving 20,000 business miles can result in a $14,500 deduction. If you are audited and cannot produce a compliant mileage log, the IRS will disallow your entire deduction. No log means no deduction. It's that simple. A good example includes precise details for the date, destination, purpose, and exact miles driven. A bad example uses vague entries like sometime in March or approximately 15 miles. To get started, first, record your vehicle's starting odometer reading. Then, choose your logging method, whether it's an app or a paper log. Finally, consistently log each business trip. Consistency is key. CPAs favor mileage apps for several reasons. They offer automatic GPS tracking, tax-ready reports that meet IRS requirements, and provide audit-proof, time-stamped records. Self-employed individuals, small business owners, and real estate and sales professionals should all be tracking mileage, especially those with high-mileage careers where the deduction can be substantial. Comparing the two methods, the standard mileage rate is simpler and generally recommended for most self-employed individuals, providing a strong deduction without needing to track all receipts. A useful year-end tip is to record your starting odometer reading on January 1st and your ending reading on December 31st. This validates the total miles on your vehicle versus the business miles claimed, a detail the IRS may audit. Here is a quick reference of the 2026 rules. The rate is 72.5 cents per business mile. Logging must be contemporaneous. You need 4 fields: date, destination, business purpose, and miles driven. Remember, your home-to-office commute is not deductible. Your action plan should start today. Note your odometer reading. Pick a tracking method like a mobile app. Log every single trip with the required details, and review your logs weekly to classify drives. Do not leave thousands of dollars on the table. Every 1,000 business miles at 72.5 cents per mile equals $725 in tax deductions. Start tracking now, as the savings are real and simple to achieve.